We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Larry McDonald. He's a New York Times bestselling author and the creator of the Bear Traps Report. Thanks for joining me today, Larry.
Hi, Tom. Thanks very much. And I'm really proud our book is now in 12 languages and just named by the CFA Institute in the top 20 all-time books in finance by the CFA Institute. And the name is Colossal Failure of Common Sense, the Inside Story of the Collapse of Lehman Brothers.
Yeah, and of course, you and I spoke a little bit about that the last time we spoke, and it was kind of chronicles your experience and your hard-won, unfortunately, lessons about that, very tumultuous time in the markets, right?
Yeah, and that kind of frames where I am today. So There's a lot of economists that have spent their entire careers looking at economic data, which is important, 80, 90% of the time that works. But there's once or twice a decade, usually 5 or 10% of the time, financial conditions and Lehman type risk will overpower monetary policy, and that's happened. It's happening now, I believe, and that kind of frames. I look at the world from a risk perspective, and we look at economic data secondarily. And I just think too many academics and economists that are on all the shows and everything. I'm in the green rooms with them on CNBC and Fox, but they just look through a totally different lens, which I think right today is extremely dangerous.
Mm-hmm. Well, yeah, I want to kind of get into, really the idea that a lot of these, data points are really looking backwards, right? But, we've seen so much volatility, let's say, in nearly every market, but perhaps one of the most notable has been the volatility of the Japanese yen and the British pound versus the dollar. So you recently wrote a piece on your site called Inside Job about the Bank of Japan's reaction to this peripheral signaling that a possible shift in aggressive Fed policy could be near. So how long do interest rates typically take to show their full effect on growth and inflation numbers?
Yeah, so the Bank of Japan issue that we wrote in our blog at the Bear Traps Report website is fascinating because they're firing these $20 billion, $20 to $30 billion barrels. So essentially, they're easing policy while the Fed is tightening, and they're easing policy at like 50 miles an hour, and the Fed is tightening policy at 150 miles an hour. And so those two things are giving you a gargantuan weakness in the yen. And in order, they should just reverse policy at the Bank of Japan, but to basically try to offset that, they're trying to defend the yen. So they threw it about a month ago. They threw a $20 billion barrel. So they came in and they just defended the yen. They burned some cash. Mm-hmm. And then one of the things, we run an institutional chat with about 650 institutional investors from 23 plus countries. And one of the things that people were saying over the last month is they're not going to do that again without more support. In other words, you don't go into a fight without a good wingman, right? And lo and behold, a week and a half, I guess almost 2 weeks ago this Friday, but within the last month, the Bank of Japan came in again. But it was very mysterious how they did that within the same hour that Nick Timmerman, the Wall Street Journal, Nick, they call him Nicky Leaks, he's the Fed pawn of the Journal, was leaking about a possible major shift from the Fed. And then you had the Bank of Canada last week. I was in Canada speaking to institutional investors. And it was amazing. 95% thought the Bank of Canada was going to do 75. They came in with 50 bips. So there's a double shift there. Then overnight this week, the RBA, which is Royal Bank of Australia, also came in with a dramatically easier shift. And so I think, to get back to your main question, central bankers are as nervous as a long-tailed cat in a room full of rocking chairs because they've hiked rates so much, but they can't see the damage of those hikes for a good 6-9 months. Milton Friedman taught us that, I think 30 years ago. And he's one of the greatest economists of all time. Any really solid economist will tell you they don't know what they've done for 18 months. Now, the Fed did 325 basis points of hikes in 6 months. In 6 months. The last couple of hiking cycles were 2 to 3 to 4, actually 4 to 5 years. Mm-hmm. And so to do that much into a planet with 50 trillion more leverage, I'm just telling you, as sure as God made little green apples, the academics don't know what they've done. So they just have to sit back and observe. Inflation is going to come down, but they have to observe what the damage that they've already inflicted to the economy, and they have to observe inflation coming down, and they have to slow down the hikes. And that's why I think that the metals have been starting to bounce here.
Mm-hmm. Well, getting back to that idea of that lag, Powell's trying to head off inflation, and in some ways, quote unquote, channeling his inner Paul Volcker. Is that an accurate comparison to be making, considering there's, $200 trillion more debt in the world today versus the 70s when Volcker had to really fight inflation by raising rates?
Yeah, it's absolutely absurd. And, there's a lot of academics and journalists that won't ask the tough questions for a whole bunch of political reasons. But I know a lot of people. I've been a CNBC. Over the years, I've been a CNBC contributor for over almost a decade, and I know a lot of these different players in these press conferences, and they'll tell you over a drink, if you ask the wrong question, you're not going to be invited back, right? And so there's like the Fed doesn't want to admit that debt and financial conditions can overpower them, even though behind the scenes they know that that's the case. An example would be just yesterday, the Treasury announced the refunding, which is basically the amount of treasuries they plan to sell in the next 6 to 9 months or a year, depending on what release you're talking about. And it came in, they upped it once, like a couple months back. Now it's been upped again, so it's an extra 20. All in all, it's an extra 50 to 75 billion, depending on which release you're looking at. And so they basically have to sell more bonds because interest on the debt alone over the next 12 months is going to be an extra 200 billion. Mm-hmm. And then you take 100 billion of what we call cost of living COLA adjustments, cost of living adjustments for Social Security and pension funds for the military. And then you have interest on reserves, which, as I talked about in my book, Colossal Failure of Common Sense, around the banks. When Lehman failed, they forced the banks to maintain strong reserves, and they have to pay the banks for those reserves. Mm-hmm. And so you're going to have about a $500 billion swing over the next year. And as Stan Druckenmiller reminds us, when you push rates up to just the 3.8%, that wipes out that literally, when you push rates up to 3.8%, that wipes out the entire healthcare budget. And so there's a media establishment, the Fed, that wants to project strength. They want to tighten financial conditions without hiking as much as possible. Like, they want to hike as little as possible, but by using the bully pulpit and their vocal cords to tighten financial conditions and scare investors. We're going to do, we're going to do it from here. We're going to do another 200 basis points in the next 6 months. And they're trying to tighten financial conditions, but the math is stacked against them.
Yeah, it's so interesting. And again, you wrote about that fairly recently, and I want to dig into that a little bit. Like, can you explain to us a little bit more about how the Fed's transfer of interest income to the commercial banks actually works?
Well, there's interest on reserves. So the banks keep these reserves, and the Fed pays the banks for those reserves. So in other words, over the last decade, every year, the Fed has been, because interest rates have been coming down, the Fed has been able to profit from their portfolio, their SOMA portfolio, mm-hmm. and send money to the Congress. And every year, like 100 billion a year. And now, because they've pushed up rates so much and rates are backing up around the world, the amount of money that they have to send the banks through interest on reserves, plus the interest, plus like you said, the COLAs, that creates a really uncomfortable dynamic where, some people will fight me on this, but essentially they're going to have to go to Congress and ask Congress for money, or they're going to be on Capitol Hill next summer, and people like Elizabeth Warren and Democrats are going to be looking at the portfolio and saying, you raised interest rates so much. Why are we sending all this money to the banks? And so they set this dynamic up after Lehman with this aggressive transfer to the banks because they wanted the banking system. One of the big problems with the pre-Lehman years was they didn't retain as much capital, and that's why Lehman was close to 40 times levered, and that created the financial crisis. So in order to prevent that, they created the system that exists today, and it's now going to be extremely expensive. So when they brag and say we want to push up rates, do X, Y, and Z, it's so preposterous because what it does to them financially and mathematically is going to come out over the next 12 months.
Mm-hmm. And that also applies to let's say the federal debt versus the interest income on its low yielding securities too, right?
Exactly. So yeah, your depends on what part. Right now, the curve today went inverted across. So 3 month treasuries are yielding more than 10 years, and they're yielding the same as 30s. Imagine that. So 3 month 10 years, which is the Hall of Fame recession indicator. Like some people look at 2s, 10s. That's 2-year Treasury versus 10, and a lot of people have been saying, over the last year, a lot of people on Twitter have been saying, okay, well, 2s, 10s are inverted, but no, you got to wait. Only when 3 month 10 years go inverted, then we're really in a recession risk. And this week, 3 month T-bills versus 10-year Treasuries are inverted. The 3 month versus 30 years are now almost inverted. They're flat. And so that's telling you that the probability of recession is 100%.
Just depends on how you decide to define it this week, right?
Yeah, exactly.
So you mentioned kind of the political nature of the Fed. And of course, the Fed is, ideally supposed to be apolitical. But is it possible that they were kind of told to pivot coming into the midterms here?
Yeah, I mean, it's so obvious that the price of gas went up since August to like last week, 19%. And so that's after we fired a 240 million barrel. It took like a howitzer. We bought 240 million barrels. We took that out of the oil. We emptied the SPR. Excuse me. We emptied the SPR, and we were trying to support the market, and which is called the Strategic Petroleum Reserve. And by doing that, they're trying to support. They're trying to keep oil prices down by releasing more oil. But oil prices, in essence, went up into the midterm, and not oil prices, but oil prices to some extent, but gas prices much more so. And so now they fired that barrel, and now the last thing left is people in the suburbs vote, and people in the suburbs have 401ks, and so there's no question that there's something happened within. I mean, we're talking about the best month for the Dow Jones Industrial Average since 1974. I mean, come on, and that's into a midterm election where Team Biden, obviously it's going to lose the House, but the Senate probability of loss over the last 6 months, 3 months has exploded. I mean, you've got guys like Herschel Walker that were considered complete busts in Georgia are now like neck and neck in the polls, and Dr. Oz in Pennsylvania was 10 points behind now. I think he's leading. So there's no question that the White House is excuse the phrase, as nervous as a whore in church, I would say.
Yeah, it's crazy how many different dynamics there are at play. And of course, I spoke with Chris Irons from Quoth the Raven about the Pennsylvania kind of dynamic there. And it's difficult to say that would be necessarily just due to, people liking Dr. Oz versus maybe not having faith in the Democratic side of the equation, right?
Yeah, exactly. But all the greats, Obama was one of the greats of all time, greatest politician. Reagan, they all struggle in the first midterm. And it's like, with this type of dynamic with the economy, the good thing going for the Biden team is they don't have like that many seats to lose. In other words, when Obama lost 63 seats in 2010, 63 seats in the House, that was because he had won so many in 2008. Whereas right now the House is close to 50-50. And so there's a lot of people that we look at. We look at rates, we look at Eurodollars, we talk to institutional investors. But one of the things that we look at is when you go from one party control of the House and Senate to two-party control, one party control to two-party control, typically bonds rally. And bonds are starting to rally here this week because you go into a massive gridlock phase. And what happens is the other party comes in and stops you from spending. And so if we still have a huge, obviously, inflation problem, but there's a problem. If the closer we get to recession and the Republicans take both the House and Senate, or even just the House, then the probability of a bond rally, it's a year end, it's January, February, it's very high.
So, Larry, I'd like to go back to, if we could, kind of let's say the mechanics of the Bank of Japan, as you said, burning some cash. So, they were selling dollars and buying yen. So how much runway do you think they have to keep doing this?
Well, we hosted a call yesterday with institutional investors, and that was one of the topics. It's like, what you don't want to do is do it by yourself more than once or twice, because it's kind of, as they say, pissing in the wind. Because if you're doing it by yourself against the beast in the market, it's very dangerous. Whereas if you have Fed support, so by doing it, the most recent example, by coming in and intervening, and at the same time the Fed is leaking a more dovish posture, it really weakens the dollar and strengthens the yen. One of the things that the institutional clients are talking about is, okay, they fired this first barrel without the Fed, the second barrel with the Fed. It's a total of maybe $50-60 billion in both. They have a lot of reserves in treasuries, but the question is, what are they selling? That people believe if they're selling treasuries and then global rates are moving against them, and then that weakens the dollar, strengthens the dollar, weakens the yen. And so it can kind of get a doom loop transaction there, which is, I think, been going on, where if they're selling treasuries to defend the yen, and global rates are moving up with that strengthens the dollar, because yield, it's very complex, but yield differential. So the higher the 6-month T-bill goes, it's 4.6%. It's going to pull a lot of money into dollars. And so this can be a very dangerous scenario, and they have to reverse it. And the only way to reverse it is with some help from the Fed. The question is, people are thinking, okay, what are they selling? Are they selling gold, selling treasuries? What's next? Are they going to sell investment grade bonds? And so a lot of institutional investors are looking at, what they're actually selling to because they're burning through so much cash. What are they actually selling to raise that cash?
Mm-hmm. Is there any risk of other countries trying to sell treasuries because of that? Let's say the Bank of Japan is there any risk of that kind of cascading to other countries wanting to get rid of their treasuries as well? Or do they need a deliberate reason, like trying to support their currencies?
Yeah, the big one would be China. And, China's been letting the yuan weaken dramatically, because, once again, this gets back to Japan has been weakening the yen so viciously that they're stealing billions of dollars, hundreds of millions, if not billions of dollars of trade from China. So if you're trying to sell a BMW if you're selling a Japanese car into the U.S. or any products between Japan and China because the yen has weakened so much. Products in Japan are cheaper around the world, much cheaper than or on an accelerated level on an equal basis because the yen's falling so fast. The central bank, the PBOC, can't weaken the yuan that fast, and so it dramatically changes the balance of trade, and it's a pretty hostile move. And I think that if I'm in the Politburo, if I'm the PBOC in China, I'm looking at that as a very hostile move. I think they're not very uncomfortable with the speed of it, and I think that the Bank of Japan is getting the message. I think they probably made threats behind the scenes, and so I don't think the Treasury or the Fed are very comfortable with it. So there's a whole bunch of players in the world that are really uncomfortable with the speed of the weakening of the yen, and that gets back to this whole trade for gold and silver, where if there's a global coordination to over the next 9 months, you've got China reopening. The dollar has been the global wrecking ball. It's crushing the global economy. You got the yen. The speed of the yen weakening is dramatically destabilizing for the global economy. So all of this comes together, and if they can weaken the dollar and stabilize that beast, that dollar wrecking ball, then that's a big positive for gold because gold has really been a victim, gold and silver of the strong dollar. Because if you're a billionaire, everybody thinks like, oh, gold doesn't do well in inflation. It hasn't done well in an inflationary period. That is such a misnomer. And I'll tell you why. Firsthand, if the Fed's pushing up rates unrealistically at a fast speed that they can't keep up, if you're a billionaire in Saudi Arabia and you can get 4.6% in a 3-month or 6-month T-bill, you're gonna buy that over gold for now because 1-year inflation expectations have been coming down fast because recession risk. So 1-year inflation. So think about it. If you're the Saudi billionaire, 1-year inflation expectations are coming down. Mm-hmm. And what do you do with $1 billion? Do you put it in gold or do you put it in bonds? And you put it in bonds, and you know what? You're pretty comfortable for 6 months because 1-year inflation expectations are coming down, and the Fed's hiked rates. You put the money in bonds, and it's a safe place, and you're capturing 4.6%, which is dramatically more than you were a year ago. The problem with that is that if inflation expectations on the longer end, like right now, 2-year inflation expectations have been spiking, and 10-year, same thing with 5 and 10s as well, but not so much. And so, if long-term inflation expectations rise and stay there, that's where gold does really well. Where people like, oh, inflation. It doesn't matter what inflation does in like 1 year, but it's when it's like in the 70s, long-term inflation expectations became unanchored. That's when gold does well. So when you hear journalists or people say, "Oh, it's an inflation year," and gold hasn't done well because the Fed's jacking up rates, they're trying to basically create a recession to slow down inflation. And so in the short term, investors can be comfortable with owning those T-bills and not gold. But over time, as inflation becomes more sticky, and we should probably get into that, mm-hmm. The long-term inflation expectations become unanchored. That's when gold shines, and that's I think is just what's about to happen.
So before we move on to, let's say, inflation and what drives it, what makes it sticky, let's say, to maybe play devil's advocate, if as Japan is, let's say, 7th or 8th, I believe, in the world of having gold reserves, what happens if they start selling their gold? Won't that create downward pressure in the gold market?
Exactly. I think I think there's a very high probability that's happening because, gold is if you look at gold versus Bitcoin, it's got to be 1,000 times more liquid. I mean, over the last 5 years, maybe that's coming down a little bit, but if you want to sell $1 billion,
gold is more liquid.
Yeah, gold's okay. That's because that's the problem with Bitcoin is that if someone comes in to sell $1 billion, if someone comes in to sell $1 billion of gold, $1 billion of Bitcoin, gold's going to be down 5%, probably probably 1%, and Bitcoin's going to be down like 10 to 20, mm-hmm. And so that's the weakness and also the strength of gold It's like when you run into tough times. This is what happened during the COVID crisis. Gold in the first opening salvo of the COVID crisis, people sell their winter. They sell what's liquid in an illiquid market, and gold and treasuries. I mean, people were just selling gold. You remember there was a day there in March 2020 where the GDX traded from like 21 to 12. It was incredible. Maybe 18 to 12. It was just people were selling gold because it was liquid. And so if you look at what the Bank of Japan holds, gold's a lot more liquid than U.S. Treasury. I'm sorry, not more than treasuries, but U.S. corporate bonds. And so the Bank of Japan owns CLOs. I mean, imagine trying to sell $1 billion of CLOs. Bank of Japan owns a lot of CLOs, collateralizing loan obligations. And so if you add the entire list of what the Bank of Japan has, gold has to be in the top two most liquid instruments.
So, with the prospect of a softer Fed coming out last week, this kind of gave gold miners a little push up. Is this a positive sign to you that the market participants are just waiting on any type of a change, of course, from the Fed to start buying again?
Well, whenever you get to the end of a hiking cycle in the last 40, 50, 100 years, that means that the front end of the rates have peaked, or at least that's the impression. And when that happens, and when front end rates start coming down, and when the risk of the Fed cutting, the market starts to price that in. So there's a very high probability that the Fed has overcooked the goose, and we're cutting next year. Like by the third quarter next year, we may very well indeed be cutting. And so we don't know what they've done. The Fed doesn't know what they've done. And so when that happens, gold miners do extremely well in every single instance. When you get to the end of the hiking cycle, where gold suffers is when you're at the beginning of a hiking cycle. It's very damaging, and because the Fed is once again pushing up those T-bills, and why own gold when you can own T-bills risk-free?
Mm-hmm. So, Larry, we've kind of touched on inflation here and there. What makes it sustainable? What makes it sticky? Are wages and labor a bigger part of this equation than maybe gets talked about normally?
Well, it's the power of labor is, if you just do the math, and if you look at the acceleration of labor union percentage, what happens with inflation is a young man or woman 2 years ago, 3 years ago, 5 years ago, that same person that would never join a labor union, right? That same person today is being hit over the head with inflation every month, with the cost of living, taxes, and it just it infuriates these families. They go to the grocery store, they're being robbed, right? And so that pushes millions of people into labor unions. And that's what's clearly happened. You look at Amazon, you look at Walmart, you can look at strikes across the United States on the rails. Look at UNP, which is Union Pacific. I mean, they're dealing with massive labor issues. And so labor unions will get stronger, and that increases the cost of labor. And that just, once again, it's like a doom loop where it creates more inflation. I did a speech in Brazil 2 months ago. Andre Estevez invited me into his office, the CEO of BTG Pactual, billionaire, wonderful guy, just brilliant man. And I walked in, he's like, it's like, Larry, I'm one of your biggest fans, and he signed my book. And I was like, wow, this guy, he's one of my economic, idols in terms of the way he thinks and looks at markets. And it's BTG Pactual. So I said, Andre, what does BTG stand for? He said, better than Goldman. and he got into the supply chains from the East-West transferring to North-South. He talked about the peace dividend coming out of the Vietnam War, World War II, and it created this massive East-West supply chain. And he said that COVID and the war in the Ukraine is going to force companies to take 20, 30% of their supply chains, and not just reshore, but have a whole new supply chain from Brazil, Mexico, Canada, the US, and have a north-south supply chain back up to China. And so that's a really powerful inflationary force. And then if you look at the Strategic Petroleum Reserve, one of the things we talked about up in Canada when we were speaking to pension funds last week was we had our team up from Washington, ACG Analytics, And one question on the table is, okay, they've drained the SPR, which is the petroleum reserve for emergencies from the United States, into the midterms. When do they refill it? When do they? It's 230 million barrels, 240 million. Now, you don't have to refill the whole thing, but you have to refill a good 30% of this real soon. Now, the problem is you can't do it in 2024 into the presidential election. So the probability that they have to do it next year is pretty high. And so that's oil supportive. That's why I think you're seeing a lot of these Schlumbergers and these XOP ETF. These things are going apparent. These things are, I think Chevron's up 30% in 30 days. And that's just something you don't see very often, right? And so people are figuring that out. So there are all these secular forces that are, really guaranteeing us much higher. Then you got the situation in Russia with the grains and the wheats, wheat where they're not allowing the harvest of the agricultural harvest areas of the Ukraine to really export. So you've got that pushing up food prices. You've got rents. Rents are like, I think, 40% of CPI. And if anybody that's ever rented a home knows that you have a 12-month lease or 24-month lease, and that lease doesn't expire for a long time. And so those rents roll off slowly. And if you just do the math inside of CPI, there's just no way. That's the fundamental, the crux of this sit-down talk that we're having is that inflation's going to come down at 10 miles an hour, but financial stability risks are moving at 110 miles an hour. And so because you have so much more leverage in the system this cycle, an extra 50 trillion more than you did the last hiking cycle under the 2018, then financial stability risks are so high and they're moving so fast that gets central bankers very uncomfortable because they don't want to create another Lehman situation. And so what they'll do is they'll soften the path, probably before the economic data says they should. And I think that's what's starting to happen. When that happens, that's going to be extremely good for hard assets. So there's financial assets in the world, there's growth stocks and bonds, and then there's hard assets. So it's precious metals, all kinds of metals, obviously oil, gas, commodities. And so I think we're probably in the third or fourth inning of the great commodity cycle.
And of course, let's say the picks and shovels of the hard assets are also quite a good play in there typically too, right?
What do you mean by picks and shovels?
Like the service companies, gold miners, oil producers, midstreams, yes, things like that, right?
Yeah, exactly. And the natural gas space. We love Energy Transfer. We love Southwestern Energy. These companies are producing so much cash. Antero. These companies are producing, you're talking about the cheapest levels in terms of free cash flow yield that these companies have ever had. And so they're just producing so much cash and they're just buying back stock, and the stock's either going to go up, several, I think 100% from here, or they just take the company private.
We've seen so much rhetoric against these oil companies. And I even saw a couple things yesterday. Of course, we're speaking here on the morning of November 1st, but Biden was going to make a statement, something to do with these greedy oil companies profiting too much in this environment. At what point do you think, Larry, that we get some type of a reverse course of this rhetoric basically threatening these oil companies?
Well, remember, the threats are coming. They're really threatening the companies with a windfall profits tax unless the companies produce more. So what they're trying to do is the companies are retaining capital and they're paying dividends and very large dividends. And so they're building capital, they're building cash, and they're not investing as much as they did in previous cycles. Now, I was delivering a speech in Calgary in 2020, and I sat down with this incredible team at Canoe Financial, Rafi Tasmani and his team. But he was saying back then in 2020 that, because of the debates, the presidential debates, where there was kill shale, kill shale, kill shale, and such a hostile atmosphere to the oil companies, including President Biden himself. Almost every debate had this on the table. And so when you talk to people in the industry back in 2020, 21, investments just collapsed. And so we've done something very dangerous where the ESG dynamic has come along, and that's been extremely popular from a political point of view. That's suppressed the supply of energy, supply of coal, supply of all commodities. And then we had this other dynamic, which is just natural, not natural, but just more like, kill shale, really focusing on green energy, which is fine. But at the end of the day, the global population since 2014 is up like 500 million. And we've taken 7 million jobs out of the United States. We've shotgunned them around the world, which is wonderful in the sense that we've decimated the Rust Belt, which is horrible. And it's extremely sad. And but we've raised the standard of living in Bangladesh, in India, in China. And if you're in India, there's 1 billion people without air conditioning, 1 billion people without air conditioning. And in China, there's 1 billion people without automobiles. So the problem is when you raise the standard of living in emerging markets by exporting jobs out of the United States, there are young men and women in India that are riding mopeds and consuming 1,000 times more energy than their grandparents. And this is the kind of the unintended consequences of global Davos crowd central planning, where you've suppressed the supply of energy, and now we've got about $1 trillion of energy bailouts. So that's in Europe and the United States, where we're actually financing, we're paying people for their energy bills and their energy costs, but that's essentially just financing demand. So our global central planners coming out of Davos have suppressed the supply of energy through ESG and through a very hostile platform. And then they're financing the demand, but into a world with 500 million more people since 2014. And a lot of those are more affluent people in emerging markets that are consuming 1,000 times more energy than their grandparents. And if you add that all up, that is one dangerous cocktail. And it's really the crux of our next book that's coming out next year, which we've done thousands of hours of research from our team together. It's really a potential colossal failure of common sense where you're creating a real sustainable energy crisis.
So, Larry, you and I talked about silver being such an exciting prospect the last time you and I spoke. Is that part of, this real, like you mentioned, the clash of common sense there? Is that a big part of why you believe silver is going to be such an important investment because of that lack of energy?
Yes, it's multiple faceted with silver, because the last couple of cycles, you didn't have the solar upside, you didn't have the electric vehicle upside. I mean, you're seeing Elon Musk threatening to buy Glencore because he knows he needs metals, not so much silver. There's some silver component in the Glencore business model, but there's a real crisis for these metals that are going to be needed for the next, the 21st and 22nd century. And silver is right there in the middle of it. And if you just look at solar, there's double-sided solar panels in China it's a new technology that are consuming, the demand from solar panels in China. If that technology takes off, which it is, so it's basically rotating the solar panels during the day as the sun moves around the earth, and you're getting more solar, you're getting more, obviously, ultraviolet, you're getting sunlight on the solar panels for longer periods of time because it's dual-sided. Those solar panels use more silver. And so the whole thing is extremely bullish. I noticed this morning that the gold-silver ratio on the screen here, and a number of institutional clients were talking about this, is around 83. And that's breaking it's the gold-silver ratio. And typically when it's breaking, if I had a chart, it's breaking a major uptrend where gold has been outperforming silver. Now silver is starting to outperform gold. dramatically. It's like the silver charts today look a lot better than the gold charts. And that's typically it means that there's some speculative money coming in. To me, it's a very bullish sign for precious metals, because when silver starts to outperform gold, then you know you're cut. It's an indicator that you're coming into a real potential bull market for precious metals.
Interesting. Well, I guess we'll have to kind of bide our time to see how that develops a little bit more, right?
Yeah, I mean, it's been here before on the trend line. It's failed. Mm-hmm. So I've been guilty of getting a little excited about this, but when it breaks, it's really powerful. Mm-hmm. And remember, the gold silver ratio in all the other commodity bull markets was much lower. In the 30s, even as low as 15. So now, granted, the silver market's a lot different today. Silver is a byproduct of a lot of exploring. So you're getting a lot of silver with copper exploration and gold exploration, and the technologies have been getting better. So there's been a lot of residual silver found today because of advanced mining and technology that there wasn't in the previous cycle. So I get that. So we'll probably never get down to the gold silver ratio that's in like the 15s again. Mm-hmm. But I definitely think you could get down into the high 30s and 40s, which means that if you remember, like the last couple of hiking cycles when the Fed stopped or slowed down dramatically in like 2015, whatever it is, I mean, the silver miners and silver dramatically outperformed gold in that world. So it's kind of like one of the first movers. And so when there's a change in the hiking, when there's this change in the Fed policy path that's meaningful, then silver really starts to outperform.
Excellent. Well, I'm sure we'll have to keep an eye on those conditions to make sure that might be, let's say, like you say, the first positive sign for a possible turn in the markets. Larry, is there anything else you'd like to share with our listeners before we wrap up today?
Just keep an eye. Our book will be out next year on Twitter. They can find us at ConvertBond. And, we're really looking at the rebalancing of the global economy over the next year as we come out of COVID, and that the planet kind of rebalances as China reopens. That still is yet to, think of what commodity prices have done with these China lockdowns. And so a year from today, you could have a much weaker dollar because the global, you're going to, by the spring, I think the financing of the Ukraine war is in some trouble because the United States is going to have, like I said, an extra $500 billion and a Republican House. So Republicans are, Ukraine's burning about $100 billion a year. And so somebody has to finance that. So that the probability of there being some type of peace negotiations in the spring or summer of next year are high, and the probability of China reopening are high over the next year. So both of those things are dollar negative and very bullish for hard assets.
Excellent. We'll have you on again at that time to evaluate that.
Well, I really appreciate you having me back on, and we'll see you at the top.
Perfect. Thanks for your time today, Larry. Really appreciate it.
Okay.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.